Hello and welcome back to the Property and Lending Podcast. Join with me as always, Fadi and Mark from Power Loans. How are you, gentlemen?
Yeah, good.
Very well. How are you?
I'm excellent. We have a run sheet for all our episodes, and the first part says intro, which we've just done, and the second part says Mark's tip of the week. Evan Fadi has added and your feelings, and how you feel. So, Mark, what's your tip of the week, and how do you feel?
Just something I've noticed with conversations with our clients. Obviously, no feelings here, but all business. So, when you look at the news reports and everything like that after the last RBA rate rise this time last month, they were sort of saying this might be the last rate rise, and there was all this speculation about it. I don't think any of these reporters really looked at the minutes of the RBA meeting, and which is one of the best indicators, because these are the guys that make decision at the end of the day, the people on the board. So just two quick things that they said in the minutes of the meeting. These are their words, not mine. So a lot of people thought 25 basis points would be the last one. There was actually arguments for them to increase it by 50 basis points, so a 0.5% increase rather than a 0.25. So what they actually said was members, as in of the board, acknowledged that there were arguments in favor of both options, but concluded that the case to increase the cash rate by 25 basis point at the present meeting was the stronger one. So surprisingly, there are people that are still pushing for 50 basis points on the board. If that doesn't tell you that there's going to be further rate rises coming this month, in next Tuesday actually, and the following months, then I don't know, I think the news is a bit diluted. They also mentioned here, members noted that the forecast for output, give me one sec. Consistent with this, members agreed that further increases in interest rates are likely to be needed over the months ahead to ensure that inflation returns to target. The target is 2 to 3%. So I think tip of the week is, if you're waiting for the interest rates to stop going up for some reason, if that's one of the reasons why you're not getting into the market now, which I don't imagine, I can't come to a conclusion why that would be reasonable, but you're going to be waiting a bit more. And because the rates are going to continue going up, that obviously means for existing mortgage holders, repayments are going to continue to increase. So reach out. Let's review your rates. It's a free check. It takes 2 minutes. Just tell us your rate, your repayments. We'll tell you if it can get better, and if it can, let's check the servicing. Let's get the ball rolling and save you some money every month. Oh, yeah, and sorry, I was just going to say as well, the inflation figure for January just got released either today or yesterday. It came back at 7.4. That's down from December at 8.4. So again, these are one of the main things that the RBA look at when they come to increase or decrease the rates. So it looks like inflation is headed in the right direction, but I definitely don't think we're there, and we're not close. So maybe a few more rate rises to come to expect.
And I think it's funny to note as well, we had one of our lenders that when the RBA passed the 0.25 and all the other lenders were passing the 0.25 or the 0.2, one of our lenders passed the 0.44 just out of the blue. So it really comes down to, like, the RBA do pass those rates, but it really comes down to what the lenders want to pass at. So that's to keep in mind as well.
Yeah, which if we go for the last sort of 9-10 months when they've been increasing, there hasn't really been a lender that hasn't taken on every single one of those rises and taken it to the customer. That very particular bank was very strange, and they actually went higher, which is not sort of the norm from what we've seen the last 9 months. They obviously can do that if they want. They don't have to RBA rate rise, but I think what we're seeing is that they're sort of just copying the RBA. But we'll see next Tuesday what they do and how the banks react over the next 10 days after the increase.
Well, that's a great segue into what we're going to talk about today. There's I don't know if you did that on purpose or not, but well done. So I guess today's topic, something that I get asked a lot, and I know you guys are getting asked a lot as well. Fadi, what's the number one question you're getting asked right now as a mortgage broker? I hope it's the same thing that I'm thinking. Otherwise, this is going to be awkward.
No, it's pretty much. I think we're all on the same page on this one. Is that, should I wait or should I buy? It's pretty much the main question at the moment. Was I right? Is that the right one?
Yeah, correct. Yeah, correct. So good job. Thank you for reading the show notes. Yeah, so that's perfect segue from what Mark was discussing. with his tip of the week. And yeah, the number one question you guys are getting, and I'm getting it as well, is should we buy or should we wait? I'll start with you, Fadi. We'll just, I guess, we'll discuss our thoughts and opinions and our processes, and see if we can help some people out there.
Yeah. Well, as you all probably already know, I'm a pretty conservative person. So I guess when people are asking those questions at the moment, I'm always going to say, listen, if you're able to purchase in this market at the higher rates here and a lower market, I like to believe. And what I advise to customers, if you're looking to borrow in this market and you're able to service and you keep your heads above deep waters for the next year or two, when the market starts to stabilize, the rates start to come down, they're really going to be left in like a pretty good position where the rates are going to start to come down and the property are going to start to go back up as well. Just how it really does work, doesn't it? In regards to if the property market's peaking, the rates are lower, like we saw. Now the property market is coming down a little bit more lower, and we're seeing the rates increase as well. So I do believe if you're able to buy in this market, if you're able to borrow, and keep in mind, if people were to come through to Mark and myself, we do those buffer rates. We also increase those buffer rates in regards to servicing to make sure they're able to service in a year or two. And if you're able to borrow in this market, I think it's a great opportunity to get in at the moment. I really do.
Yeah, for sure. Mark, do you have any pointers or different opinions to Fadi on that one?
No, I think it's the same. I mean, we've seen a lot of customers pick up steals like there was one particular one in Moorebank just a few weeks ago. I really couldn't believe the purchase price he got for the plot for 800 squares in Moorebank was quite ridiculous, and you can build a duplex. So I think we're seeing a lot of people, a lot of savvy investors picking up on these deals. In that particular one I'm talking about, they sort of had zero competition whatsoever. So their first offer that they put in, which was under market, was accepted and was done in a day. I think real estate agents understand where the market is, and they're informing their customers. They're informing the vendors that there's not going to probably be a bidding war. Going to auction is probably going to be more expensive for them, and it's not really going to get them the outcome that they want. So purchasing properties nowadays, whether it's investment or an occupier in a market where you're not bidding against anyone, for me definitely makes sense. What the other sort of way that I explain to my customers is that when you're coming to purchase, right, there are a few things that impact your repayments: the loan amount and the interest rate, right, and the loan term. Obviously, the loan term is always going to be 30 years if it's a brand new loan and you're buying a property, so that's not really a factor. But we're looking at the rate and the rate and the loan amount. And I asked the customer, what exactly is in your hand? What can you control? Can you control the rate from the bank? No, you can pick the bank that provides the best rate for you, that you service with the most like the lowest fees, which makes sense. But what you can control is the time in the market that you buy to ensure that the loan amount is lower than it would have been if you bought this time last year. I mean, a lot of people are waiting for the rates to start going down, but because so many buyers are waiting for that time, you're going to be left with a loan amount that's higher. So the repayments probably won't even be less. The rates aren't going to go low quickly as well. It's going to be a very slow sort of grind when they come down. Inflation is very high at the moment. So if you're sitting on the fence and you're waiting for rates to come down, you're going to be waiting for a while. And the market's going to not wait for you as well. I mean, we saw one of the things we saw in the last the data for February was that Sydney actually increased for the first time in I don't know how long. Kane, correct me if I'm wrong. It might be like 9 months, 10 months. I don't know how long it is. But Sydney actually went up, and all the other states had a decline, but it was a very small decline, maybe 0.03, something like that. Again, Kane, correct me if I'm wrong, but. For me, it looks like we're sort of making a turn. A lot of people are waiting for these. Sorry, I know I'm talking a lot. But a lot of my customers as well are talking about this mortgage cliff that they keep hearing about. All these people are coming off fixed rates and whatever. Anyone that has a home, it's going to be the last asset they're going to give up. They're not going to give it up quickly. They're going to get a second job. They're going to not go on holidays this year. They're going to pull their kid out of this childcare and go to this, whatever it is. They're going to not go childcare as many times. People will hold on to their assets for as long as they can. If they absolutely can't, they'll contact the bank. They'll make a payment plan. The bank will sort of tell them just do interest only payments now, or they'll put some sort of payment plan together for the customer to have maybe 6 months to get their head above water. So I don't think there's going to be this massive crash that people are talking about. I think the Australian market is very resilient, and I don't think we've seen historically where multiple years in a row we've seen the Australian market as a whole decline. I don't think that's something we've ever seen historically. So I don't think it's something that's going to be seen moving forward as well. What do you think?
Yeah, for sure. I mean, I agree with everything you said there. Yeah, and the recent CoreLogic data, showed that Sydney increased by 0.3%. That's really more of and that's kind of really backing off the premium locations in Sydney not declining as much as they have been, and kind of have been steady, which goes to show that Sydney as a whole, that data, that metric without context is somewhat useless. But also telling you that, okay, well, if these, because it's saying what the data is saying is that Sydney has dropped so much, 1%, 2%, whatever it is, over the last few months. But that's all of Sydney, which when they look at the data, includes Point Piper, Vaucluse, Bondi, whatnot, then also includes Campbelltown, Liverpool, Parramatta, and surrounding suburbs, Penrith. And the price differences are so drastic that it doesn't make sense to group these suburbs. Where, like, we got your 5 million plus locations of in areas at around 700 grand. And when Point Piper or Vaucluse, Bondi drops 1% or 2%, it's a big number. It's a couple hundred grand, if not more. Whereas when, say, Campbelltown goes from 700 to 720, that percentage increase is so small that it gets eaten up in the wider data. And now what we're seeing is that the Sydney has come up 0.3% based off these top areas not going up, but just not going down. It's indicating that a lot of these areas have been stable, if not have increased actually over the last few months as well, which is kind of what we've been saying all along as well. There are definitely deals to be found, like that Moorebank one you mentioned. I mean, the issue still remains there's a lack of stock across the country. So, and like you said, if people are in economic strife, the last thing they're going to do is sell their house. And it was the same situation we had with COVID, and it's a very, very similar conversation that we had on this podcast at the time when COVID was first starting, back in 2020, 3 years ago now. It's been that longer. And where Matt Common said 30% drop in property prices, and Matt Common is the CEO of Commonwealth Bank, and I'm sure he's a very intelligent guy to get that job. But it was one of the dumbest comments he's ever made. And I'm happy to say that because we had that podcast straight after he said that, and real estate is not run on logic. It is purely run on emotion. And a real estate property is not just an investment in someone's home, and it's a fundamental need. So people will do whatever they can to hold on to that property. So during COVID, people didn't go overseas. Obviously, they didn't go on holidays. They saved every dollar they had. And there was a lot of government stimulus as well to help hold on to those properties. So we saw a lack of stock on the market because no one was selling, because, well, if they didn't have to, they weren't. And we're seeing a very similar thing now where it is still very difficult to purchase. We were looking at a property for a client in Adelaide over the last few weeks, and the property was worth around 400. We were around that kind of price point, and it ended up having 15 offers on it and selling for about 480 grand. Right, so the market is competitive. You just have to look at some context and not just listen to what the media says. So I agree with everything you said there, and I think I'll take it one step further as well. And I've been trying to create this post for our socials, but I'm not very good at graphic design, and it's quite a difficult post to create. But essentially, I've been looking at the data since 1970 till today in every city in Australia. I've been cross-referencing it with the RBA, every year's average interest rate that the RBA has put out, and then cross-referencing that with any notable economic events, 9/11, the GFC, when GST was introduced, and all these things. And I can, without giving away and going into too much detail because it probably bore some people, there's a lot of numbers. I can guarantee you, if you bought property in 1970, you'd be a very, very happy person right now. And if you bought it in 1980, you'd be very, very happy as well. And the earlier you purchased the property, essentially, the happier you were, despite these economic events, despite interest rates going up and down. And interest rates are going to go up and down every month for the rest of our lives. It's just how it goes. Every Tuesday, except for January, there's going to be an announcement. And if we are continuously making investment decisions that last 20, these decisions should be for 20, 25, 30 years, based off the last Tuesday, and that last Tuesday's rate announcement, you're not really building off a strategy, and you're going to be living in fear for the rest of your life, and you're not really going to make a decision. We made a post a couple of days ago that actually showed the difference of waiting 1 or 2 years only. And so, Fadi, if you purchased a property today for 500 grand and was getting 5% compounding growth, and Mark bought one, the exact same property next door, next year, whatever it was, and I bought one 2 years after, you would be ahead of Mark after 25 years, purely based off compound growth. You're getting the same growth on the same purchase price. You're going to be ahead of him by 150 grand. You'll be ahead of me by almost 300,000, simply because you started earlier. So I think that the idea is, and it's a catchphrase and whatnot, is time in the market is way more important than timing the market. And I think that's what I speak to all my customers about, is if you are financially capable to purchase property now, that's the big number one thing that you got to be able to make sure you're going to be okay with. Yeah, we can't ignore that interest rates are higher, and you have to be able to make these repayments, and you have to be able to live. But if you can and you can afford it, now is the time to buy. If you can't afford it, then it's not the time to buy. The best time to buy is when you can afford it, because the longer you hold that property, the more money you're going to make, right? And compound growth is the eighth wonder in the world for a reason. It is going to make you more money than trying to time the market. It's also impossible to time the market. If today might be the bottom of the market, we don't know, right? Because, well, it wouldn't have already been. We've already passed the bottom of the market technically, because we've already come on a little bit of an upswing with Sydney technically 0.3% in the green. That might come down next month as well. It might go back down to zero or whatnot. But trying to time this perfectly, impossible. It's impossible. So you're always going to miss the bottom anyway. And then when you're trying to time it, you're playing on short-term time frames. And in the real estate market, you're not trying to make money in short time frames. It is really definitely about the long-term growth. So I agree with what both of you have said. And I think history has shown us that it's pretty simple. If you can afford it, now's the time to buy, and we just got to buy in the right areas.
And I think that's basically what it comes down to. And I think that's something that we all mentioned as well. And you said it, I guess you said it in a better way than I did, KM, in regards to if you're able to borrow now and you're able to service a loan, and like we discussed, like we also put buffers in place just in case there's increases in the near future in the next 6 to 12 months. But if you're able to purchase now in this market, and to be honest, every time we talk about like when's the right time to purchase or not, it really isn't the best time, because either interest rates are low and then the purchase prices are high, you need a higher deposit, you got stamp duty costs have gone up as well, or interest rates are higher and the market's low and you can't afford, or you're not able to service a loan because the rates are higher. So it really does come down to if this is the best time or you're able to borrow and service a loan now. I honestly think it's a great idea, because let's say you keep your head above waters for the next 6 months, 12 months, 18 months, 2 years, you're going to see growth. You're going to see those rates coming down, your loan repayments coming down as well. And also, I like to think that property was to always go up, like we always discuss. It's always going to go up. I understand, like I'm going to be a bit of devil's advocate here, but in regards to the COVID period, I think we just saw too much money being lent out, which did remind me of 2009. And the reason why I say that is because this is money that was lent out. Have we ever been in a position where they've lent out this amount of money out? Has the buffer rate ever been that low, the assessment rate?
No.
Was COVID definitely the lowest, correct? So that amount of money being given out, that's the only worrying thing that I'm going to come down to in regards to, do I believe there's still going to be, a bit of, market decreases towards the end of the year, towards the middle of the year? I believe that we'll see a little bit more reductions. I see like Mark's, in regards to Mark's customer, I reckon we see a lot more bargains, like Mark discussed in regards to bargains coming on the market, not having that much of a competition. But we have to also consider that the amount of money that was given out, like we're also going to pay for it as well. And we hope that, like Mark said, man, I'm going to do everything I can to hold on to my asset. But at the same time, let's keep in mind that, once you come off that fixed interest rate, you're looking like anyone with like an average of $1 million home, you're looking at a minimum $1,600 extra to your monthly repayment as well. And that doesn't include like everything else, groceries, petrol, rego, everything has gone up as well. So if you can keep your head above waters and also afford into this market, I don't know, this might be a good time.
Yeah, I mean, I think as well, like what we sometimes tend to forget when we see this doom and gloom of the property markets crashing or going down and whatnot, down 2%, 3%, whatever, 5%. This is backing off a historic 40, 50, 60% growth, right? So you haven't lost money. You've gone from 500 grand to 800, and then 800 back down to 750. You have not lost money. You 250 grand ahead of where you were, or from 1 million to 1.4, then back down to 1.25. You're way ahead. The issue is obviously where people purchased at 1.4, and then that's kind of come down a bit, and they're in negative equity at the moment. But obviously, if they can hold on to their properties, real estate is a forgiving market, and eventually, time will heal that wound. So I think that's something to consider as well. But going off what you were mentioning there, I had another point, but it's lost. It's gone into the clouds. So I'll let Mark take over.
I was going to say, I've got, just as well, like you guys were chatting, I just put down 3 quick points. So first thing is, if you're buying a property with the intention that this is going to be positively give property covering itself, this is a great time to buy. I mean, rent is absolutely insane. If you open the news, you'll see a report about it every few days. Anyone that's a landlord would see their rent increase a lot since last year. And anyone that's trying to rent is going to have a very difficult time as well, because they such limited supply pushing up these prices. So in terms of being a landlord at the moment, although your mortgage is going up, rent is also maybe not keeping up, but it's still going up quickly as well. The second thing I was going to say is, you guys were saying now is the right time to buy if you can afford it. Right now, your loan is being assessed at minimum 8%. Minimum 8%, probably 8.5%. There are some that are above 10 already. So the bank is also very, very, very conservative. If you earn any type of income that's not sort of guaranteed, it's usually shared at 80%, sometimes less than that. If you started a second job, we can't actually use that until like 6 or 12 months, because the bank wants to know you can keep 2 jobs. So the bank is very conservative with how they give out their money at the moment. So if you can service the loan right now with how they're assessing your file, then you should be okay to continue so long as your income doesn't reduce. That's the second thing. So the third thing as well I was going to say was just a question to put out there for the customer that thinks that they should be waiting until the rates go down. What do you think is a better investment? Purchasing in 2021 when rates were 1.99, 2.09, 2.19 with incredibly high prices, maybe 30% higher than now, or purchasing now where the purchase price has come down maybe 10%, but you're at the same rate as that person that bought 2 years ago. That person that bought 2 years ago, that fixed rate, that incredible rate with a very high purchase price, because there's a lot of demand, right now is going to be at the same rate as you. They're in the same position, but with a much higher loan. So would you rather buy with a much higher loan, given that even if you get a good rate now, in 2 years' time, you're going to be in the same position as someone buying in a much higher rate? I'd rather the lower loan.
That just tells you can't judge the market. Like that point just there, you just can't judge the market.
Yeah.
For sure. I remember what I was going to say, because it was kind of what you were talking about as well. A little bit different. I think as well, in terms of people trying to time it, and why this is probably a good time if you can get in. I think as soon as we see, and because this is based off history and historical data that I've been studying for a little while, I think as soon as the official cash rate Maybe not when it holds, but as soon as we get a few consecutive months of no increases, and maybe that first interest rate decrease, whether it's in 6 months or a year, whatever. As soon as that happens, I think you're going to see a lot of buyer sentiment come back like that, and it's going to flood the market, and it's going to be extremely competitive. So if you are able to get in beforehand, you're going to take advantage of that extreme demand. Obviously, you got to be in the right location, as we always say, location, location, location. Come by anywhere and anything. But I think as soon as you see that first decrease, and even if it might not even be a decrease, it might be 3 consecutive months of no change, where the sentiment comes back, where people say, okay, it's not that bad, or we're at a point where we can forecast our monthly repayments, and we know it's not going to keep going up and whatnot, so we can work with this interest rate. But I think definitely that first decrease is going to throw a lot of buyers back into the market.
I think everyone will be throwing a party.
Really competitive. Yeah, it's going to be very, very competitive.
Yeah.
We see it time and again in history. Whenever there's a drop, people flood the market immediately.
I think as well, buyer sentiment will go up the first time RBA hold the interest rate as well. Because, so I think we'll see a flood of pre-approvals coming at that stage. I was also going to say 1st of July, when the government scheme comes out, where at the moment, the first home guarantee scheme, the threshold in Sydney is 900K. Anything over that, you can't use the government scheme, the 5% deposit with LMI waived. The new government scheme that's being introduced 1st of July, the threshold's up to $1.5 million. A lot of first home buyers that have contacted me personally are waiting for that scheme, because this is the scheme where you'll only need to service the debt of 60 to 70%, because the government will actually contribute a much higher amount and will actually own a portion of your home, but will allow sort of lower income earners, medium income earners to purchase at a lot higher than what they would now with the first home guarantee scheme. So I think we'll see an uplift in that particular market in Sydney, up to 1.5 mil after July as well. May take a few months, but there'll be quite a bit more demand for those particular properties, I think.
So in regards to those properties, if you were to sell the house later on, when you sell the house, the government takes the 30 to 40% out of that, and you take the 60, or how does that work?
Yeah, I believe so.
Because I had something similar to this in Western Australia. I don't know, maybe it was like 5 to 8 years where you had customers. I think there was 50-50 back then as well. I don't know. I think we've discussed this. I think Mark and I have discussed this. I don't know if I'm a fan of this one. I don't know why.
No, I mean, it's definitely not for anyone, but I see it working for low income earners that are looking to get to a property that's maybe $1 million, 1.2, but can only service really a loan of 600 and only have like a 3% deposit. Like, it would work for them. Definitely
so
doesn't work.
Long-term hold. They'll be like their forever home, their long-term hold kind of thing.
Yeah.
And how would do you know what's interesting? Like, I don't know if we know this yet, but how would it be accessing equity in that property? Are you able to?
I don't know. I feel like all the information hasn't come out about it as well. It's a good point, because technically you own either 70 or 60%, depending if it's new or existing home. Surely you wouldn't be able to take out more than the normal
70. Yeah. So let's say up to 80% of 70%, you can probably take up to. So these are some things like. Because I think we've discussed this one, because I love the 5% government scheme that we've got at the moment for the first time buyers. I think it makes sense, and it does work out in their favor, like throughout the whole 30-year investment. But this one, there's just so much questions coming up. I think that's time for another podcast, but that kind of topic.
For sure. I think I asked Mark about it a few months ago. And we don't have the answers yet. I don't think they've released all the information.
Do you remember the one in Western Australia, KM? Like the one where they did pretty much the exact same thing. And I remember running into 2 to 3 customers, and they purchased, this is probably 10 years ago, those customers purchased, and they were like struggling to sell their home at a certain price, or they're going to lose money because they only earned about the 50%. They're going to sell it at a loss. So it kind of left them with a debt as well. And I ran into 3 customers just caught us out of the blue. So I don't know, man. I don't know how I feel about that one. I'll be upfront in regards to that.
We'll have to wait and see exactly what the details are, and we'll run an episode on it. But just based off, just finishing on the, whether we should buy now or wait, I think, we're pretty in sync with our thoughts. Anything else to add on to that, or I think it's pretty straightforward. But if there's anything else to add, now's the time to do so. Nope. All right. Well, thank you guys as always for your expertise, and thank you, Mark, for sharing your tip of the week.
And no feelings.
Next week we're gonna get some feelings out of
We're
it.
gonna get some feelings out of it, man.
The listeners want to know how you feel, mate. That's why we're growing so quickly, because people know people have a connection to you.
You can at least tell us about your day, or
just
something.
we'll change
You
your
gotta give
segment
us
to
something.
Mark's tip of the week and how he feels about the weather or something.
Give the people what they want, man.
Yeah, it's what the people want, man. It's what the people want. Anyway, thank you everyone that listens weekly. Our numbers are increasing, and if you can subscribe on Spotify or Apple Podcasts, wherever you listen to, it's great for the algorithm, and it shows it to more people. And if everyone could just tell one person, I think we've just ticked over 6,000 downloads. So if everyone tells one person, we're going to hit some double-digit thousands pretty quickly, which is pretty cool. It's a lot of people listening. So
Can we get one of those big balloons with the 10,000 on it, and it pops?
Yeah, Mark will pay for it, and we'll find out how he feels about him paying for that next week. Thank you to everyone that's listening. Stay tuned for next episode, and ciao.
See ya.